Today, I want to talk a little bit about the owner equity section on a balance sheet. Now, depending on your business structure and legal entity type, these might end up looking a little bit different or having slightly different terminology. But the overall way that they work is effectively the same in all businesses. So in the owner equity section, we're going to have things like owner contributions and distributions moving in and out of the business. And depending again on that entity type and structure, we might see things like common stock or, a specific amount of partner equity for each partner that is in the business. Now, here is what's really important to remember. Equity is not income or expenses. It is other events basically that are happening in the business. So let's go ahead and talk about these different events and how they end up showing up on your reports. So let's talk first about what an owner contribution is. Basically, if you as the business owner put money into the business, either as a startup cost or if you pay for something personally that should technically be recognized as a business expense, we're going to see our owner contributions account increase. Okay, what's important to recognize here is that this is not going to show up on our profit and loss in the form of income because technically it is not income to our business. We are contributing money to, again, either have startups or to cover other expenses. And basically, we're doing that with the understanding and the hope that our business is eventually going to become profitable and be able to pay us back. So we see the owner equity section on our balance sheet increase. An example of this would be if you were just starting your business and you wanted to go ahead and get some of your dues and subscriptions that you might need or purchase equipment for the business. You might transfer $5,000 from your personal account to your business account to help cover those startup costs. And that would be an owner contribution. So we would see the owner's equity section on the balance sheet, whatever that happens to be titled, increase by $5,000. Now, it is entirely possible that you might see owner contributions and owner distributions as separate line items, but oftentimes when I'm going through and naming accounts for the chart of accounts, I'll create an owner investment section, and that will basically handle all of the incoming and outgoing contributions and distributions that an owner might be taking. Now let's go ahead and talk a little bit about distributions on the equity section of our balance sheet. A distribution is just the opposite of a contribution. It's money that a business owner is taking out of their business. Now, a couple things to remember here. First, we want to be sure that that is allowed based on the legal structure of our business. Some businesses you actually need to take payroll from, so maybe a straight distribution isn't necessarily the answer. But if that is not the case, if you're a sole proprietorship or if you have certain types of LLCs, you can actually just take distributions out of the business. Now, here is the really important thing to remember about these distributions. Same as contributions not counting as income, distributions don't count as an expense when you take them out of the business. They are still taxable to the business, so it's not going to have any impact on your profit and loss. Another thing to keep in mind here is that when we're looking at our balance sheet, we can and frequently do actually see owner contributions or owner investment as the equity account go into the negative, right? Because eventually, hopefully, your business is profitable enough that you can take more money out of it than you originally put into it. So let's say, for example, that you contributed that original $5,000 into your business and your business has slowly been paying you back over time, say $1,000 a month as it has had the cash flow to do so. Well, you have fully paid back that $5,000 to yourself, and now you want to continue taking money out so that you can spend it personally. Well, if you continue transferring money to your personal account, you would just classify those to that same owner investment or distribution account, if that's what you chose to name it, and that would continue to decrease the equity that was available in the business. One common pitfall that we really want to be careful to avoid is classifying contributions and distributions as income and expenses, respectively. We don't want to mess with that element of our profit and loss or balance sheet. It's very important that when we receive money as a loan, basically, it is not recorded as income because that can artificially inflate our income number. Same when we take distributions. If we put that into an expense account when it doesn't belong there, we're going to look at our profit and loss and see inaccurate numbers. We're going to see higher expenses than should actually be reported there. So we want to be sure to classify these things correctly so that our reports are complete and accurate. So let's look at what this actually ends up looking like in your accounting file. Now, to find your owner contributions, you'll go to your balance sheet, which you can find by selecting Reports from the left-hand navigation menu and then going to Standard Reports. The balance sheet is going to show up in the favorites by default here, so we can just go ahead and click on that. Now, the equity section of our balance sheet is all the way down at the bottom. And we can see, as I discussed in the first portion of the video, I've set up an owner investment account here. Okay, now let's look at the activity in this account so that we can see what examples exist for the contribution and distribution situations that we were discussing before. Now, if I actually click on any of these underlined numbers, that will drill farther down into the report, so I will be able to see more detail about what makes up that total. And we can see here, there was a beginning balance from prior to the beginning of 2026. So what I'll go ahead and do is, instead of just saying this year to date, I'm going to go ahead and update it to all dates. Now, we only ended up with one extra transaction, but now we know what that beginning balance of $1,000 was. So we can see right here, we had a couple different things happening. We had a $1,000 deposit, and I can see that that went into my business checking account. Now, what this tells me is that I, as the business owner, was contributing the initial $1,000 for that checking account. And then we recorded it as an owner contribution, so we see this equity account increasing in value. Now, the second one here is a little bit more nebulous, but if we expand the description here, we can see that we were recording the initial purchase of 100 books that were purchased for the business to sell, okay? So what this is telling me is that I actually personally paid for those first 1,000 books, and now the business is going to need to reimburse me for that money. We can see here at that point, I actually hadn't taken any other money out of here. Although if the business had the cash available, I would be entitled to reimburse myself those $2,000, which is awesome. Now we see there was actually a negative number coming through right here. Okay, so what does this mean? This means that I did something to cause my owner equity to decrease a little bit. Okay, and in this particular instance, I actually didn't start paying myself back, which I could have done, but I accidentally used my business credit card for a personal purchase. Okay, now since the business owed me $2,000 and this personal purchase was only $186.27, I still have over $1,800 of owner equity in the business, and the business still technically owes me that money, so it's going to continue to show up here unless and until I initiate a transfer to pay myself back. Okay, so this is how we might see owner equity increase or decrease over time. So it's really worth exploring what you want these reports to tell you. If you just want to know broad strokes, how much you contributed to your business and therefore how much you can take back out, great. This is going to be perfect for you. But you can do slightly more granular and more detailed reporting. And if that will be necessary, for example, if you have a business partner and you each contributed equal amounts, you would want to make sure that you are being paid back equally as well. So that's where you might want to see a little bit more detail and a little bit more specifics involved in the accounts that are used here. So there are instances where you might want a little bit more detail, but that doesn't necessarily apply to every type of business. If you're just a solopreneur and you are the only one involved in the business, if it's just a sole proprietorship, you might be able to get by with just an account like this one to report all the in and outflows that take place in the course of running your business. If you have any questions about this, please do leave those in the comments below. I'm Holly from Accrual Mistress Bookkeeping and Consulting, and if you found this helpful, please don't forget to like and subscribe.